Hello, Jeff Boxler here. How are you? I am going to speak about fixed rate mortgages versus ARM products versus interest only, and why each of them are good for specific situations and why you might consider one or the other depending on your situation in life and how you're looking to finance this home or condo. So, with that said, if you like this content, you have more questions, please comment, please like, smash that subscribe button below. I'd love to get your feedback and create more content for you to ensure that you're staying well informed and you're being a responsible homeowner, knowing exactly what you're doing and why you're doing it, and just setting you up for success with home ownership. So that said, fixed rate mortgages, what are they? They are a 10-year, a 15-year, and a 30-year fix traditionally. That means that your payment is either getting paid back, your loan is getting paid back within 10 years, 15 years, 30 years. Naturally, if you get a shorter time frame like a 10-year, you're going to have to pay more money on a monthly basis quicker and pay that back off quicker. What's nice about that, the shorter time frame, you're going to get a lower interest rate. And every payment that you make is going to go more toward building equity in the property. That said, traditionally, most people end up buying a house and using a 30-year fix. It keeps the payment low and allows them to pay that off over time, over 30-year fix or 30 years. That is something that's great for those that want comfort. They know they're going to be in their home for quite some time, and it allows them to plan ahead accordingly. With a 30-year fix, with a 15-year fix, with a 10-year fix, know that you can always pay extra. If it's something that you want to make bigger strides, pay it off sooner, you could pay one extra payment every January of the year, for instance, and there's no problem to doing that and cutting off time to the overall time you have that mortgage, lowering the amount of interest you pay to the bank. So that's the most common sense cookie cutter loan product out there that you can get, and most loan officers are going to talk and present that to you first and foremost. Where things get more confusing for a lot of clients, but could be equally beneficial or more beneficial than a fixed rate product, is an ARM product. There's 3-year ARMs, there's 5-year ARMs, there's 7-year ARMs, there's 10-year ARMs traditionally. Sometimes there's even 15-year ARMs. What an ARM means is adjustable rate mortgage. What the time period means is how long that rate is going to be stable, fixed in place before it adjusts. So a 5-year ARM would mean that the rate's going to stay fixed for 5 years, and then after that it will adjust with wherever the market is at. Traditionally, people choose 7-year or 10-year ARMs. It gives them 7 years or 10 years to have that fixed rate in place. It tends to cover the average time frame that people are going to be in a house or be with one mortgage. Traditionally, people change mortgages or change houses within 5 to 7 years. So a 7-year ARM for many people can be a good, safe bet. For other people, a 30-year fixed, again, is a better safe bet because they know they're going to be in that place for quite some time. A 10-year ARM is even better bet than a 7-year ARM because it gives you those extra 3 years to be in the house or be in that mortgage without rates changing. It protects you for that time frame, and then after that, if rates go up, you're exposed to higher rates. If rates go down, you get to benefit from lower rates. And so what's really important about ARMs is to have a good understanding about how long you expect to be in that home and your projections on where interest rates will be 1, 2, 5, 7, 10 years from now. So that's always important to keep in mind and try to have a good gauge on. More than anything, just like with the fixed products of the 10-year, 15, 30-year fix, the shorter period on the ARMs is going to get you a lower interest rate. So a 3-year ARM or a 5-year ARM, you're going to get a lower interest rate than a 7-year or a 10-year. So the longer out you go to protect your interest and protect your expectations around what that payment's going to be, the bank is taking more risk that if rates go up in the meantime, and now they're offering a 5% interest rate to you, whereas rates are at 7%, they're losing out on 2%. And so there's risk to them. The longer term you have that loan fixed in place, the more risk there is to the bank. So they honor the shorter terms with lower interest rates. And lower interest rates is honoring the lower risk to the bank. So just know that the longer you go out, the higher the rate tends to go. And that's just something, again, that it's a dance of trying to figure out what is more important to you, the certainty or the time or a mix of both, in regards to that interest rate being fixed in place. Lastly, we have interest onlys. Now, interest onlys are connected typically to ARM products. So 3-year ARM, 5-year ARM, 7-year ARM, 10-year ARM, which means that during that time frame of 3 years, 5 years, 7 years, or 10 years, you're getting to pay only the interest part of the payment. You don't have to pay principal and interest. What that means is you get a lower monthly payment since you're only paying interest. Where people really like interest onlys are those that have other needs for that dollar amount, or they have cash flow desires, or they're going to take that money and put it in the stock market as a hedge against interest rates, as a hedge against the investment in the house. I see interest onlys tend to be best for people that have quite a bit of money on the sideline and can bear the risk should interest rates change over the time period, should they need to pay that mortgage down at some period of time, since they're not paying it down on a monthly basis through principal payments, that they have enough money to honor and take on the need when needed. So interest onlys are really helpful and important for people that want to keep their money out of the house, and they have the ability to pay that mortgage down whenever needed. So the most risky is the interest only. The moderate risk is the longer term ARMs, like a 7-year and 10-year ARM, because again, most people change houses or change mortgages within 5 to 7 years. And then the least risk is the fixed product that always know what the rate is going to be. The last kind of commentary that I'll make, and then I love again to hear your comments, subscribe, etc., is that the big thing that you're making the difference on is a 30-year fix. I like to look at as if it's an insurance policy. Typically, you're paying more money than that 10-year ARM or 7-year ARM because the interest rate is slightly higher, and so you're paying more money every month. That difference between the payment is your insurance policy to be able to sleep well at night. So there's always a financial piece to this and a bet on where the markets are going to be 7 years, 10 years, where you're going to be with the housing, etc. But the big question also circles back around to the emotional experience of that mortgage and whether you're being able to sleep well at night. So as you're trying to figure out which is best for you, am I going to be able to sleep well at night, is a very important factor. And it may be far more important than saving $50 or $100 per month because you're getting a slightly better interest rate. So no matter what, you can always ask your mortgage loan officer about a comparison of the different options and to talk through them as you're trying to make that decision. But it's a worthy, at least, conversation, even if you know that you're going to go the 30-year fixed rate route. Because there might be some new insights that you uncover in talking it through. So I hope you really appreciated this explanation. And again, I'd love to hear your comments below. Until next time, Jeff Boxler here.